Hi, everyone, and thank you for joining us today for the second installment in Qualia's Executive Perspective series. I'm Brian Thome, VP of Customer Success at Qualia. In this series, we speak with industry experts about market trends, business positioning, and their perspectives on growth, customer experience, technology, and more. I'm here today with David Townsend, President and CEO of Agents National Title Insurance. Thanks for joining me today, David.
Brian, happy to be here. I appreciate it.
Awesome. Well, as many of you know, David is a veteran of the title industry with many years of experience in real estate and title law. Not only is he president and CEO of Agents National Title Insurance Company, he also teaches title insurance practice at the University of Missouri School of Law, is a speaker for the American Land Title Association, the Mortgage Bankers Association, October Research Seminars, and other continuing education seminars. We're so excited to have him as a speaker with us today. Before we get started, just a quick logistical note. If you have any questions during today's discussion, please go ahead and submit them in the questions pane. We have a lot of attendees today, so we may not get to all of them, but we will follow up with you directly if your question is not answered. Also, if you're having any technical difficulties, try refreshing your browser. Great. So to kick things off, David, can you give our listeners a bit of background on you and your role at Agents National?
Sure, happy to. Back in 2005, which seems like ages ago, I founded Agents National Title to address the needs of the independent agent. At that point in time, there had been a lot of consolidation in the marketplace, and really agents in our home state of Missouri, they only had the big five at that point for choices for title insurance underwriting. And I also saw that there was a need for technology in our industry. Before, agents were using paper policy jackets from their underwriter, and we were the first underwriter to be 100% online for policy jackets and CPLs. We've never issued a paper jacket, and we just kind of brought it forward from there. And now we're licensed in 46 states, Puerto Rico, and DC.
Oh, that's fantastic. Congratulations on the growth. And I know you also recently joined the Board of Governors for American Land Title Association as well. And congratulations. I know you're going to have a big impact there.
Thank you. Yeah, no, that's a lot of fun giving back to the industry that's given so much to me.
Fantastic. Well, to set the stage a little bit, let's talk about the current market. What are you seeing in the market as it relates to volume and activity, and where do you see things heading?
Sure. Well, I think it's no surprise that for the most part, refinances have evaporated. I think many people were shocked at the speed by which the refinances went away. It was like they were here one day, gone the next, because of the whipsaw effect on rate increases. We went from 2.5% to 5% in just a matter of weeks. And anytime you see that type of volatility, you're going to see changes, very quick changes in the market. And so refis evaporated. You might see some here and there cash out refis, things like that, but for the most part, everybody that locked in at under 3.5%, they're not touching that mortgage until they either need to sell or until something happens that causes them to make a change. So what that means is we've moved to a purchase market, a more traditional market where purchases rule, and title agents and direct operations are more in your traditional sales cycle, getting riding the wave of purchases in certain parts of the country in the spring and the summer, and then having it cool down in the fall and the winter, and going from there. Second home sales are starting to cool. You're seeing more and more on the market for longer, and prices are softening a little bit. I also think prices are stabilizing a little bit. I mean, the industry was white hot. It was hard to buy a house if you were looking, because there were 5 offers in the first hour of a house going on the market, and many of them for over asking price. And you really can't be a first-time home buyer or somebody that's wanting to get into the market competitively in that type of competitive market, because you have to be cash ready and looking to buy immediately. And now I think there's going to be a little bit more normalcy going on the home buying process, where people will be able to make better decisions as far as what home they need, what can they afford, and the higher rates have brought prices down a little bit. Now, not everywhere, and it's going to be market driven, but inventory or lack thereof is still causing prices to remain higher. One prediction I want to talk about that I made a year ago was that defaults would be higher. Well, they're not quite. So we thought that that would be a good industry to go into for 2022 and 23, but you're just not seeing the defaults materialize like you thought, like we thought during the last slowdown.
Yeah. And what do you think's driving that, the lack of defaults this time around?
I think it's quality of borrower and the equity in the home. Between, from 1999 to 2007 and 8, you had, it was the wild, wild west when it came to lending. It was very, you had the liar loan, stated income, and a lot of people that shouldn't have homes or multiple homes bought them. And as a result of monetary policy coming down from the Fed, we've all watched The Big Short, I think, where there's a certain person in the movie who talks about having 4 houses and put zero down for all of them. And as a result, if you've got nothing in your home and you're underwater, you're going to walk away from it a lot more easily than if you have 80%, 70% in equity, or sorry, 30% equity and 20% equity, where you put 70% or 80% down. You're reticent to walk away from that investment at that point in time. Previously, people were making their auto payments and foreclosing on their houses. Now people have enough equity in their homes that they are staying there, and the quality of borrowers much higher. You had unprecedented oversight in lending for the past 10 years when it came to borrower quality, what it took for credit, for down payments. The secondary market really tightened up. You didn't see the credit default swaps and synthetic CDOs popping up like you did before, with the tranches of A, B, C, and D paper all mushed into one.
Yeah.
So market conditions were much better to prevent foreclosures. And the other thing was we had a total economic collapse the last time. Now employment is sky high right now. I mean, people aren't losing jobs, or if they are, they're able to find another one. The jobs market is extremely hot. Most recent job numbers that have come out recently are on the increase. So, we might be heading towards recession, but that's only on some indicators. The job market and other things, gas prices are coming down, jobs are up. It's just a weird market right now. But really, unless we have major layoffs, I don't see default really happening in 2022 because of just the health of the borrower and the health of the job market at this point.
Well, that's great, and I definitely hope you're right.
Me too.
Um, and I know you mentioned you have offices in 46 states. Yeah, I'm curious if you're seeing any differences kind of regionally, especially in the purchase market, yeah, given that that's where things are shifting, or what are some of those regional trends?
Oh, no question, no question. Obviously, our agents in certain parts of Florida still just going crazy. People are flocking to the Sun Belt states. Nashville, extremely hot market, where where the jobs are, extremely strong markets. Where we're starting to see a softening is the second home market. Just south of me here at Lake of the Ozarks. For those of you that like the show, it's not quite the same. Not every houseboat has a bunch of cash in the pontoon. So, but what we're seeing now is I watch a lot of houses there because I think the second home market is kind of the canary in the coal mine when we're getting ready to have a real slowdown in housing or in the economy. People during COVID bought up all of the vacation homes because they could work from anywhere, and that was that was a good thing. They'd rather work on the water at the Lake of the Ozarks than work in St. Louis
Yeah.
or Kansas City, so they'd move down there. More and more companies now are expecting their employees to come back to work, be in the office more. Their leisure time is not what it used to be because now kids' activities are picking back up. All this stuff is happening. So we're seeing now, instead of lake homes being on the market for 1 to 5 days, you're seeing them on there for 60 days, 90 days, 180 days with price drops. Before they were going for over asking. Now, one that I was watching that I actually toured because I liked it, it's actually dropped $50,000 since the 1st of June. A pretty significant drop in the price. And it's had, it's been on the market now for a little over 60 days. And I think that you're going to see a continued softening in that second home market. And that's usually a leading indicator that, yeah, the home market is starting to cool a little bit, and going from there. But you get other places like Lake Geneva, Wisconsin, where that's a second home market, but it has a huge Chicago influence. Those houses are staying pretty solid because inventory is not as high there. Lake of the Ozarks, it has more coastline than California, so there's
Yeah.
tens of thousands of homes there, more inventory, and that's what's going to be driving a lot of the regional growth. How accessible is home building? Are there barriers to entry for a home builder? Is permitting too expensive? Are land development costs too expensive? So if there's access to land and development opportunities, I think you're going to see a robust housing market. If it's harder to build, like say Boulder, Colorado, where there are strict limitations on what you can do with new and or existing homes, prices are going to remain high, inventory is going to remain tight.
Got it. And so with those conditions in mind, I mean, things are really different than they were even at the start of this year. What advice would you have for agents and how to best react and then adjust their business accordingly?
Sure. If I was a title agent right now, I would be investing in technology to help me work more efficiently because you're going to have employees that retire or change jobs. You might not want to replace them. And how do you do that? Well, you have to work more efficiently. Is your software working efficiently? Do you have a solution for escrow reconciliations? What about order intake? Sending orders out to real estate agents, to the consumer, finding out ways to work more efficiently through production. Do you need a full exam staff, or can you order production from your underwriter? What is out there as far as what can you leverage instead of having to bring on more full-time employees? When we're in downtimes like this, when I say downtimes, slower times, it's still a very good market for a lot of folks out there, especially if they're focused on purchase. It's really about now's the time to really leverage your efficiency so that when eventually rates come back down to the 3s and the 4s, you're able then to meet demand when it comes, instead of having to hire up and fire down, which a lot of the small to mid-sized agents just can't do that. A lot of their employees, the average tenure is 10 to 15 years. You don't want to, you just do layoffs. It's different for a large national organization that only does refis. They have no choice. They're going to have to cut. That's just the nature of the beast. The large directs, the ones that work with the national lenders. But if you are, most agents out there are small to mid-sized agents, and so it's finding ways to do more with what you have right now, and not. And I think a lot of those agents didn't hire up a lot because unfortunately you can't. There's not examiners. You can't walk out your front door and see 3 title examiners or 2 escrow closers. It's much harder to do that. So I think agents have done a good job of adapting and finding ways to find efficiencies in their office.
Yeah, that makes sense. And it's been such a hot hiring market. It's been tough to add staff a lot of times as well. So
Oh, no question.
really focus on efficiencies, automation, looking at whether there's parts of your process that you can outsource. What about on sort of the vendor side, vendor management? Do you think there's opportunities there?
Oh, I think there's a ton. I think if I'm a vendor right now and I want to work with a title agent, now's the time to get in front of them. I think the NS3 was a great opportunity for a lot of companies, Alta One, Springboard. But really, the agents, there's so many opportunities now with APIs and software integrations that if the agents have a good software system that is, it doesn't end at this wall right here. They're connected, to the internet, and they can get, production, escrow help, oversight from wiring, on help with wiring instructions, either with certified or other products that are out there, Funding Shield, that have great products to protect the consumer's wires. I think that's a huge help. We've been discussing before, there are a lot of agents out there that have never known a downtime. The ones that started from 2012 on, really, they've only known growth. They've not seen a real slowdown. We were starting to see one a little bit before the pandemic hit, and then it just took off after that because rates plummeted. So a lot of those agents have not had to manage around that, and so they haven't had to be efficient in working with outside vendors, whether it be policy typing or plant posting, things like that. Plants still need to be posted even in slower times because things are still being recorded. So I know some companies do that internally. Well, if that person retires or leaves, look at outsourcing for that. There's a lot of great companies in the Alta marketplace and all over that can help you with that. So working with vendors, managing your vendors is critical. But if I'm a vendor right now, I am reaching out to every agent with any type of time or cost savings that I could to show them, hey, here's the value that I bring to you and to your customers.
That's great. And we've talked a little bit now about some of the ways to save costs and expenses. For those companies that are still looking to grow or find new sources of business, what advice do you have there on ways to still be growing?
Yeah, I mean, it's all about getting out in front of the customer. And I've banged this drum for years in that we have a lot of tools in our toolbox already, like home equity. That's a big one. The lenders out there need searches for home equity. They might not get an insurance product, but guess what? That's revenue coming in for your company to help the local lenders with their HELOC products. Finding a way, if you have an automated title plant, ways to then leverage that plant with other people using it as well. And my favorite one, the Alta leasehold policy. I've talked about this before, where there's no reason why you couldn't go to a commercial broker and say, look, you've got a lot of commercial space here. The Alta leasehold policy protects your tenants in case there's a title issue that is superior to their lease. This policy will pay to move that client. And if you have two identical office buildings that you're competing against, and if one offers a leasehold policy of title insurance and the other one doesn't, and everything else is the same, why wouldn't somebody choose that? It's just an extra benefit. So there are a lot of things that we have right now that we're already doing that our customers have no idea that we do. And so I think it's a great time right now to really get out there and market to everything that we are doing. Working with the new real estate agents that are coming on right now and the existing ones, go into their office, talk to them about the importance of surveys, what we look at, walk them through a commitment, show them what we do, and show the value of our product. And I think that's something I think right now that is a little bit of a little bit of work now that'll pay dividends in the long run, where all of a sudden you become the subject matter expert to those real estate agents. I mean, I think the biggest currency that title agents have out there is their knowledge, and they can work with the title or the real estate agent to show them, look, you come to me when you have real estate questions. I'll be your expert, and they become dependent on you, and that's how you gain more business, is that stickiness with the client.
Yeah, and I imagine, especially over the last couple of years, as busy as things have been, many agents probably haven't been able to put as much time into that education. There's a lot of people that have come into the market as agents in that time that probably could use that.
No question.
Another thing that often changes or comes up during downturns or more challenging economic times are changes in kind of security practices and threats. I'm curious if there's anything that you're seeing on that front.
Oh gosh. Yeah, I mean, right now, anytime there's any economic turn, the fraudsters come out, and I think wire fraud is nothing new. We've been talking about this for a few years now, but it's expanding. It's hitting more rural areas now as well too, because some of them might not be as sophisticated. There are a lot of banks out there that share Fed wire accounts, and so as a result, they're going in and spoofing the bank for bank-to-bank transactions. So payoffs are getting diverted at this point, which is dangerous. So that's why using proper wire controls like a certified or funding shield or one of those products, it's critical in a lot of places to make sure that the consumer and the title company's money is being protected. Now, once FedNow and once the new, I just blanked on it, on the real-time payment system. Sorry. So when real-time payment systems and the Fed now come in, there'll be more secure ways to transfer money, and the amounts are high enough now that it's economically viable. So that's something that I think that is critical to our industry to prevent the fraudsters. But what we're seeing, what's old is now new again. We just saw the old hey, I'm gonna send a cashier's check in for a contract. They call a week later, the contract is canceled. Hey, can you wire me my funds out? And that cashier's check never had any money behind it, never cleared, and then that agent is now out the money. So the fraudsters, it's a tale as old as time, and they just recycle a lot of stuff, but they do it more sophisticated each time.
Yeah, yeah. So keeping up security like we've been doing, but paying attention to any new trends. I think the wire verification services seem to be adding a lot of value. We're hearing.
Yeah,
A lot of
and then we always talk about MPI as well too. I mean, I know you all do a very good job with having secure servers. We had last year, the last couple of years, a pretty big one in our industry on hosted services. So making sure that where your data is hosted is critical, and having access to it. So, I mean, I think that's something that agents need to be very aware of, that ransomware is out there. And so be very careful on how you are storing your data and accessing your systems.
Yeah, absolutely. And I think two-factor authentication or multi-factor authentication is a good best practice to have in place. And a lot of platforms out there make that easy to enable, but it still takes users to turn it on or not turn it off.
We put that in Alta best practice just because of that. And if you are hosting your data remotely, you better be using multi-factor authentication.
Yeah, I couldn't agree more. One last question for me, David. Just is there any other advice as we're wrapping up here that you would have for agents going forward that we haven't talked about
yet? I would say get involved in as many things as you can, whether it be Alta, your state association, sitting in on webinars like this. Get all the information possible that you can, because right now is where you build the future. It's before, it was easy money. This is the time where agents succeed and fail, because it was getting 20 or 30 refinance transactions a week, just spillage coming in was easy. But now you've got to really work for it. How are you marketing? How are you working more efficiently? And now is the time to really set up for success for the future, and work with all your tech partners. Invest in it. It's not money out the door. It's a force multiplier is what it is. I mean, I could go out and lift a rock, but if I had a lever, it'd be a lot easier.
Yep, exactly. Yeah, and it's times like these where the companies that come out the other side come out stronger and better for those improvements that they make along the way.
Exactly.
David, thanks again for the insights. It's a lot to think about and really informative. And we do have a number of questions that are coming in.
All right.
So we probably aren't going to have time to get to all of them today, but we will follow up with anyone we don't get to after the webinar. Let me go ahead and see we probably have time for a couple. I guess this first one is related to, what do you see in terms of trends of digitization in the industry and how that's progressing or will progress?
Oh, that's a good one. Okay. And I liked how they use the term the digitization or the digital future here, because I think we've beaten Ron to death over the last 2 years. And Ron was always seen as, okay, this is something that we need to do. I think Ron is just one aspect of it. And blockchain should have put us out of business years ago. That was always blockchain is going to end title because we're going to lock down all the records. It can be a tool, but where I see is I see the digital marketplace only increasing. Digital mortgages and digital notes, they are going to be the future at some point, because lenders, they need speed to market. They don't want to have to deal in paper. If they can have something signed, transferred to them, and then saleable on the secondary market in a matter of hours as opposed to a matter of weeks or months, it's only going to increase their ability to churn and do more loans, which therefore brings down prices. Mm-hmm. So I think technology is finally catching up to what's happening. There's a company out there that uses Surface tablets that have a really high pixel quality to be able to do a wet digital signature and then do an e-recording of that. Every state has e-notaries. And so an electronic notary, different than Ron. This is an
Yep.
in-person electronic notary, and then e-recording. So right now, what's holding us back is not every county in the US has e-recording. And so if I could do one thing to really speed this up, it would be wave a magic wand and have every county be e-recording. I know Indiana's taken big steps to that, where they have a mandate that says by this date, I think 2024, all counties have to have e-recording. I would love to see that nationwide, because there's no reason why you shouldn't be able to take paper, scan it in your office, and then record it, or have a digital copy and then send that in. I mean, it's just, this is 2022. We should be there by now. But counties, they don't have the funds for this. Some of the smaller counties, they only get a few documents a week recorded, so they might, well, we don't need to upgrade to that. Well, at some point you will. So because I want to say it's like 5% or less transactions involve Ron, but last time I checked, every transaction used a mortgage and a note. So unless it's cash. So and so therefore, I think the digital mortgage is going to get adopted a lot faster, I think, than a Ron, because there's a lot of risk with Ron still. A lot of lenders, they don't want to hold the recording for years. There's a lot of private data involved with that. However, having a tablet and just having a consumer sign that at closing, I mean, I bought a car this spring. I did it all on my phone, did DocuSign, everything else like that. It's a secured interest, just like, but the difference is that that's a statewide database as opposed to county by county by county. And so I'm not advocating to change the way we're doing that, but counties just need to get a little bit more online before it really takes off and we get more lender adoption of the digital note and mortgage.
Yeah. So it sounds like digitization is only going to continue to increase, but probably going to continue to take some more time as all the necessary pieces get put in place. But variety and flexibility of options is going to be key. Ron is a method of doing this that is useful in certain transactions. There's other ways to do this as well, whether it's through digital tablets and probably things that haven't even been brought to market yet.
Exactly. I think the pandemic really moved things a lot, moved forward. I mean, we developed a decision engine to do title using title data, like plant data, title data, MERS data, public data, and credit data to create a refinance commitment in seconds. I mean, that it was needed because getting the access to the records and the data was harder during the pandemic. So we had to, there was a great leap forward during the pandemic on technology, both on Ron, but also on decision engines and just digitization of our industry, moving data from one place to another without humans to a certain degree. Now, one of our agents went old school. They, instead of doing Ron, they just rented an old bank and had the tubes where they shot the mortgage documents through the little tubes and had the teller windows that slid out into the cars to sign documents. So you can go old school or new school depending what's available in your county.
Love it. Great. I think we have time for maybe one more question.
Okay.
This next one is related to what do you see in terms of trends of consolidation or M&A potentially over the next few years?
Oh gosh, I think we're going to be having a period in the next 5 years of, I don't want to say unprecedented consolidation in our industry, at least on the agency level, but it's going to be heavy. What you're seeing is a lot of companies where the owners are they're at the end of the line as far as, I'm tired. I've made it through the last this refi thing about killed me. I'm done and I want out. Or they built it up to a certain size. Their children might not want to take over and they're ready to be done and they're going to sell to somebody, whether it's an underwriter, private equity, other agents. I think you're going to see more and more agents selling. But the nice thing about that is it's just like in banking. When Bank of America buys a large regional bank, shortly thereafter, the principals of that bank then start new banks all over the place, and then the cycle repeats. So we're going to have a lot of consolidation, but because county records are county records and they're not statewide, you're going to still see a lot of agents popping back up because, if service falls in that new company that was purchased, the previous employees might break out instead of, well, if they built this company up and sold, why can't I? And so
Mhm.
you'll see that churn, but I really do see a lot of consolidation in the next 3 to 5 years. I think prices are going to be a little bit more reasonable because the next couple of years of earnings aren't going to be as great as the previous two before that, because you don't have the glut of refinances. I mean, that's just like when an anaconda swallows a warthog, it's going through and moving. That's the refi profits that are moving through the P&Ls right now. They're going to go through, and you have to look, okay, what's the average then in a normal market? And I think that's a discussion for another webinar about valuations of title companies. But you're going to see that where people are wanting out, and there's going to be, instead of closing it up, what they're going to have something to sell, and so you're going to see that consolidation happening at a faster rate in the next 2 years.
Fantastic. Well, thank you so much for that, David. And I think we're just about out of time, so we're going to go ahead and end it on that note. But again, we will follow up with anyone that we didn't get to your questions after the webinar. And thanks again for joining us today, David. Really appreciate you and the perspectives you shared. And have a great day, everyone.
I appreciate it. Thank you.